Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Today, we're taking a look at the financial performance, the year-end financial performance of two companies in the manufacturing one sector, and we're speaking today about One Caribbean Media, OCM, as well as Angostura Holdings Limited. Now, there were different performances between both of the stocks. One Caribbean Media continues to decline in terms of profitability, while Angostura Holdings Limited did manage to deliver very impressive returns on a year-on-year basis. Let's look first at One Caribbean Media, or OCM, and for the financial year ended December 2018, One Caribbean Media, or OCM, delivered earnings per share of 28 cents, which was an almost 60% decline from the 69 cents per share reported in 2017, its fiscal 2017. Now, revenues declined just around 11% from $442 million to just around $394 million, and overall profits for the period also declined from $52.4 million to just around $20.4 million. Now, a lot of that decline was attributed to reduced operational performance, but also some increases in impairments, specifically related to financial assets as well as non-financial assets, including some recent acquisitions. Now, as we take a look at the profitability trend of OCM, we can see it has been a persistent decline over the past several years. In fact, after peaking at just around $110 million in financial year 2015, it has now declined to that level of just around $38.2 million. And its profit before tax margins have also come under some pressure, falling from just around 21% to its current level of 8.6%. And this is pretty much in line with the trends we've been observing in the traditional media space, where alternative media routes such as social media and other online media, which have been more effective at targeting specific customers or potential customers, have taken over really from the traditional media space, newspaper, television ads, radio, etc. So the good news is that OCM has begun to position itself to take more advantage of the digital advertising age. How long that takes to result in increased earnings, well, that's anyone's guess at this point in time. At the current price of $10.15 per share, OCM trades at a price-to-earnings ratio of 36.3 times, which is at the higher end of the manufacturing one sector, but offers investors a fairly attractive dividend yield of 5.9%. That comes with a pinch of salt, however. In its most recent period, its current trailing dividend yield is just over 200%, meaning that for every dollar that OCM earns, it pays out around $2 in dividends, at least in the past financial year. And over the past 3 years, for every dollar that it earns, it would have paid out $1.35 per share. So questions on investors' minds would be, of course, how sustainable is that sort of dividend payout over time? So based on declining performance, but a reasonably attractive dividend yield for now, Bourse maintains a neutral rating on OCM. Turning quickly to Angostura Holdings Limited, for the financial year ended 2018, Angostura delivered an earnings per share figure of just around 63 cents, which was a very tidy improvement of 16.7% from the 54 cents per share reported in the prior comparable period. Now, revenues were up just around 5.2% from $745 to $783 million, and gross profits were also up from $367 to $391 million. Profit before taxes were up as well from $154 to $177 million, and profits for the period up 16.9% from $111 to just around $130 million for 2018. Now, taking a look at the revenue story for Angostura Holdings Limited, well, recent accounting changes would have led to restatements of their 2017 and 2018 period, how they recognize revenue, and therefore it sort of renders the financial 2014 to 2016 period irrelevant from a comparison perspective. Nonetheless, there was an improvement of that 5.2% from 2017 to 2018. And of course, when we look at profitability in terms of margins, again, discounting the 2015 and 2016 periods, because of that change in accounting treatment, there was a marginal improvement in its profit before tax margin from 21 to 23%, and that's in the green column, 17 over 18. And its gross profit margin also increased just a tad from 49% to 50%. So at a price of just around $16, Angostura is trading at a price-to-earnings multiple, or price-to-earnings ratio of around 25.4 times, and its dividend yield is below the sector average of 4.6%. It's actually about 1.5%, so certainly on the lower end of the dividend yield spectrum, which may not appeal very much to most investors. At its current valuations, it seems as though the stock is priced for growth. How much of that growth has already been realized or how much is ahead in the future, again, only time will tell. So based on a turnaround in financial performance and its increase in earnings, but some fairly above average valuations, Bourse maintains a neutral rating on Angostura Holdings Limited. That's it for this week's edition. For more information, give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com or visit our website at bourseinvestment.com. Have yourselves a wonderful investing week. This has been the Bourse Report.